If you're receiving Social Security right now, or you're about to start, there's something happening behind the scenes that could quietly increase your monthly check, and most people have no idea it's even possible. This isn't a new stimulus bill. It's not a surprise bonus from Congress. It's not a flashy headline. It's a small technical change inside the Social Security system that can permanently raise your benefit if certain conditions apply. And the truth is, many retirees are either underpaid or not realizing they qualify for a recalculation. Before we go any further, if you appreciate clear, calm updates about Social Security, SSI, SSDI, and retirement changes without fear or rumors, make sure you're subscribed. This channel is about facts, not panic. Now let's talk about what's really going on. Here's what this means for you. Social Security calculates your retirement benefit using your highest 35 years of earnings, not your last 35 years, not your best job, your highest 35 years after adjusting for inflation. If you worked 40 years, only the top 35 count. If you worked 30 years, 5 zeros get averaged in. And that's where many people get confused. Every year you work, your wages are recorded by the Social Security Administration. Those wages are indexed for inflation, meaning they're adjusted to reflect today's dollar value. Then they're averaged to determine something called your primary insurance amount. That number becomes the foundation of your monthly benefit. Now here's the part that's often overlooked. If your earnings record gets updated, even years later, your benefit can be recalculated. Sometimes wages are reported late. Sometimes corrections are made by employers. Sometimes self-employment income gets adjusted after a tax return amendment. And sometimes people continue working after they start collecting benefits. When that happens, Social Security doesn't ignore the new information. The system automatically checks whether your new earnings replace one of your lower earning years inside that 35-year formula. If they do, your monthly benefit can increase, and not just temporarily, permanently. Let me explain why this matters. Imagine you retired at 66 with a benefit of $1,620 per month. At that time, one of your 35 years included a relatively low earning year from early in your career, maybe $12,000 in today's adjusted dollars. Then at age 67 or 68, you worked part-time and earned $28,000. If that $28,000 replaces that older $12,000 year in your calculation, your average goes up. Even if it only increases your monthly benefit by $32 or $45, that change lasts for the rest of your life. And over 15 or 20 years of retirement, that adds up. This is what's called an automatic recomputation. It's not new legislation. It's not something you apply for separately in most cases. It's built into the Social Security formula. But here's where the little noticed change comes in. Over the past year, Social Security has been placing greater emphasis on earnings accuracy and record corrections. That includes faster processing of updated wage reports and adjustments related to delayed disability approvals or amended tax filings. In plain language, the system is actively reviewing and correcting records more efficiently than many people realize. That can mean some beneficiaries are seeing slightly higher deposits, sometimes a few dollars, sometimes more, because their earnings history was updated. And when Social Security owes you money from prior months due to a recalculation, they issue a retroactive payment. That can show up as a separate Treasury deposit. Now, I want to be very clear. This is not a blanket increase for everyone. It doesn't mean every retiree is getting more money next month. But if you continued working after claiming benefits, corrected an old earnings error, had a delayed disability decision, or recently updated tax filings, this could apply to you. This is where many people get confused. They assume their benefit is locked in forever the moment they start receiving checks. And while your base formula is established at retirement age, it is not frozen if new earnings qualify to replace lower years. Social Security runs automatic reviews each year, typically after updated earnings are posted. So if you worked in 2024, for example, that income is generally reviewed in 2025 once the wage data is finalised. If it improves your 35-year average, your benefit can be adjusted upward. And the adjustment usually applies starting in January of the year after the earnings were received. Let's say you worked in 2024 and your earnings replaced a low year. In 2025, your monthly amount might quietly increase, and you may receive back pay covering January through the month the recomputation was processed. That's why some people notice a slightly larger check and aren't sure why. It's not random, it's math. It's the formula working as designed. Now here's something important. Even small increases matter. A 28-odd monthly increase equals $336 per year. Over 20 years, that's $6,120, not including cost of living adjustments layered on top of that higher base. And since COLA is applied as a percentage, a higher base benefit means future COLAs are calculated on a slightly larger number. That compounds over time. So this little noticed change isn't dramatic. It's not headline grabbing, but it is meaningful. It reflects the Social Security Administration's continued enforcement of earnings accuracy and automatic recomputation rules. And if you're someone who worked beyond retirement age or corrected a wage issue, you should understand how it works. Because the difference between assuming your benefit is fixed and understanding it can adjust could mean thousands of dollars over your lifetime. In the next part of this discussion, we'll talk about exactly who is most likely to see this kind of increase and why some people receive retroactive lump sums while others simply see their monthly deposit rise quietly without explanation. Now let's talk about who is most likely to actually see a bigger monthly check from this little notice change. Because while the rule applies to everyone in theory, in practice, certain groups are far more likely to benefit. First, retirees who kept working after they started collecting Social Security. This is more common than people think. A lot of Americans claim benefits at 62, 63, or 66, and then continue working part-time. Some return to work because of inflation. Some do it to stay active. Some just need the extra income. What many don't realize is that every year you continue working, Social Security reviews your new earnings. If that year is higher than one of your lowest years in your original 35-year calculation, it can replace it. Let's look at a real-world style example. Linda from Ohio retired at 66 with a monthly benefit of $1,340. She had a few lower earning years early in her career when she stayed home with children and worked part-time. At 67 and 68, she worked seasonally and earned about $32,000 each year. When those earnings were posted and indexed, they replaced 2 older years in her 35-year record that were under $15,000 in today's adjusted dollars. Her monthly benefit increased by 58 ounces. That may not sound life-changing, but that's nearly $700 per year. And because that higher base amount receives future cost of living adjustments, the increase grows over time. She also received a retroactive deposit of a few $100s because the adjustment applied back to January of that year. That's one group. Second, people who had delayed disability approvals. If you applied for SSDI and your claim took months, or even more than a year, to approve, once approved, Social Security recalculates your benefit back to your established onset date, minus the 5-month waiting period required under the law. Sometimes during that time, updated earnings records are processed, or benefit formulas are finalized later than expected. When everything is corrected, beneficiaries can receive back pay, and in some cases, small ongoing increases if wage corrections improve their record. Third, people who corrected an earnings mistake. This happens more often than people realize. Employers occasionally report incorrect wages. Self-employed workers sometimes amend tax returns. Names and social security numbers sometimes get mismatched in reporting. If an old year of earnings was underreported or missing entirely, and it gets corrected, that can change your 35-year average. Here's where many people get confused. They assume an error from 15 or 20 years ago is too old to fix. But in many cases, you can correct your earnings record if you have documentation, such as W-2 forms or tax returns. If that correction raises one of your top 35 years, your benefit can increase. Fourth, retirees who were previously affected by earnings limits before full retirement age. If you claimed benefits early and were still working, some of your checks may have been partially withheld because you exceeded the annual earnings limit. For 2024, that limit was $22,320 for those under full retirement age. For those reaching full retirement age during the year, a higher limit applied for the months before full retirement age. When you reach full retirement age, Social Security recalculates your benefit to give you credit for months where benefits were withheld. This often results in a small increase in your permanent monthly benefit. Many retirees never realize this adjustment happens. They just notice that their check increased slightly after reaching full retirement age. Again, it's not random. It's a recalculation. Now let's talk about deposits, because this is where confusion spikes. Some people see a second deposit in a month and assume it's a mistake. Others see a slightly larger payment and worry about overpayment corrections later. Here's what you need to understand. When Social Security recalculates your benefit due to new earnings or corrections, two things can happen. First, your ongoing monthly benefit increases. Second, if the adjustment applies retroactively to January of that year, you may receive a separate lump sum deposit covering the difference for prior months. For example, if your monthly increase is $42 and the adjustment was processed in September but applied back to January, you could receive 8 months of back pay, around 336 days, in a separate Treasury deposit. That separate deposit often appears with a description like SSA Trees 310. It's legitimate. It's not a stimulus check. It's not a random bonus. It's a catch-up payment. Now let me explain something else that matters. Medicare Part B premiums can also affect what you see deposited. If your gross benefit increases by $50, but your Medicare premium is deducted directly from your Social Security check, your net deposit may increase by slightly less, depending on premium adjustments. Sometimes Medicare premium corrections themselves trigger small reimbursements if too much was withheld in a prior month. That can add to the confusion when multiple small deposits appear. But the key point is this: these adjustments are formula-based. They are tied to earnings accuracy and benefit recomputation rules that already exist under current law. They are not cuts. They are not political giveaways. They are mechanical corrections inside the system. And while not everyone will see an increase, those who worked after claiming corrected earnings, had delayed disability processing, or reached full retirement age after early claiming are the most likely to notice it. Here's what this means for you. If you have worked even 1 year after starting benefits, you should understand that your record is reviewed annually. If you had a low-earning year in your 35-year average, replacing it with a higher year can permanently lift your monthly check. Even modest increases matter when you're on a fixed income. And if you recently saw a slightly larger deposit and weren't sure why, there's a strong chance it came from this automatic recomputation process. Now let's bring this all together and talk about what this really means for your financial stability, not just this month, but for the rest of your retirement. Because here's the truth. When people hear small increase, they sometimes tune out. They think, well, it's probably only $20 or $30. That won't change much. But when you're living on a fixed income, every dollar has a job. Let me explain why this matters. If your benefit increases by $25 per month, that's $300 per year, Over 15 years, that's $4,500, and that's before future cost of living adjustments are applied to that higher base. If your increase is $50 per month, that's $600 per year. Over 20 years, that's $12,000. That's real money. That's groceries, that's utilities, that's prescription coverage gaps, that's property taxes in some areas. And here's something even more important. Because COLA is calculated as a percentage of your benefit. A higher base benefit means every future cost of living adjustment compounds on top of that higher amount. So if your check goes from $1,600 to $1,650 because of a recomputation and a 3% COLA is applied, that increase is calculated on $1,650, not the old amount. It builds from there. This is how long-term retirement income strengthens quietly over time. Now, I also want to address something many of you are thinking. You're hearing constant headlines about Social Security funding. You're hearing projections about trust fund timelines. You're hearing politicians debate reforms. Here's what you need to know clearly and calmly. Under current law, Social Security retirement and disability benefits are being paid in full. Monthly checks are continuing. COLA adjustments are still being applied annually based on inflation data. The change we've discussed today is not connected to cuts. It's not tied to a new political bill. It's part of the existing benefit formula working exactly as it was designed to work. It's about earnings accuracy. It's about recalculation. It's about making sure that if you earned more in a later year than one of your lowest years, the system reflects that. That's it. This is where many people get confused. They assume that once they start benefits, nothing can change except cost of living adjustments. But the truth is, your record is dynamic if you continue working or correct earnings, and sometimes that dynamic adjustment works in your favor. Now let's talk practical strategy. If you do receive an increase, even a modest one, use it intentionally. First, don't immediately raise your monthly spending commitments. Avoid locking yourself into new recurring expenses. Second, consider strengthening your buffer. Maybe that extra $40 or $60 goes into a small emergency fund. Even building a $1,000 cushion can reduce stress dramatically when something unexpected happens. Third, review high priority needs. Are there medical supplies you've delayed purchasing? Dental work you've postponed, home maintenance that prevents larger repairs later. Small consistent increases can help you address these things gradually instead of all at once. And please be cautious. Whenever headlines mention bigger checks or SSA changes, scammers move quickly. Remember this clearly. The Social Security Administration will not call you demanding personal information to release an increase. They will not charge a fee to process a recomputation. They will not threaten you over the phone about a benefit adjustment. If someone contacts you claiming they need your bank details to process your higher payment, hang up immediately. Your legitimate adjustments happen automatically based on your earnings record. Now, before we close, let me summarize the most important takeaway in simple terms. This little noticed SSA change is not a new stimulus. It's not a surprise bonus. It's not a temporary program. It's the system reviewing your updated earnings and correcting your benefit if new income replaces one of your lower years. If you worked after claiming benefits, corrected an old earnings mistake, reached full retirement age after early claiming, or had delayed disability processing, you could see a permanent increase. Even small increases matter over time. Your base benefit can rise. Your future COLAs build on that higher amount, and retroactive deposits may appear if adjustments apply back to earlier months in the year. Here's what this means for you. Don't assume your benefit is frozen forever. Review your earnings record through your My Social Security account. Make sure all 35 of your highest years are accurate. If you worked recently, understand that the system may review and adjust your benefit automatically once wage data is finalized. And if you've already seen a slightly higher deposit and weren't sure why, now you know. it's likely the formula doing its job. Retirement can feel uncertain sometimes. Prices rise, headlines create noise, policies get debated, but clarity reduces stress. When you understand how your benefit is calculated and adjusted, you regain a sense of control. Your work history matters, every year you paid into the system matters, and ensuring that your earnings record is correct is one of the most powerful steps you can take to protect your monthly income. If you feel comfortable, let me know in the comments what city and state you're watching from. Different states have different SSI supplements and cost of living realities, and it helps others compare experiences. If you've ever found an error in your earnings record, or if you've noticed your benefit increase after working past retirement age, your story could help someone else realize they should check theirs too. We're navigating retirement together, with facts, not fear. Your Social Security check is not just a number. It represents decades of work, and making sure you receive every dollar you earned is not optional. It's essential. Stay informed, stay steady. And remember, sometimes the biggest improvements come from the smallest adjustments done correctly.